advantage you have in the United States, you do have a lot of communities and federal or agencies that are more or less constrained to make a certain amount of green energy. You don't have that in Europe, so that's an advantage here in the United States. And secondly, jobs. You know, I never see cost calculations that include the negative figure of what does it cost to keep a person unemployed. You know, that should be added to all the other cost calculations you do. Let's hear now.
Why don't you put me last?
Oh, okay. Put you last, all right. So everybody will stay. That's very good. But I hope everybody does everywhere. And I think you would agree that the content of all the presentations have been so great that our questions should be kept to last also, because a lot of the questions should be answered by subsequent speakers, or just note down what you want to talk about, perhaps have coffee afterwards. Okay, so let's hear now from Marc Schultz. And he's a tax attorney, and he's going to tell us about taxation. Is that correct?
Yeah. Federal tax credit fund.
Federal tax credit fund. And are you going to also address the issues of these nonprofit entities? Wonderful. We'd like to hear.
Good afternoon. My name is Marc Schultz. I'm a tax attorney with a firm here called Snell Wilmer. I've been doing tax credit financing for around 10 years now. I moved to Phoenix from Chicago, where I worked with a firm that had one of the largest tax credit financing groups in the country, where I started doing low-income housing tax credit deals representing investors, developers, and, syndicators, and then a program called the New Markets Tax Credit. And then before I left, I started doing wind projects where we utilized something called the production tax credit. And out here, a lot of my, most of my practice in the renewable energy space is focused on solar, which is something called the investment tax credit. So let's get started. Okay. So here in the United States, our system is, from a federal standpoint, is based on the monetization of tax benefits, which are credits and depreciation. One of the reasons when you ask folks, you know, why have we employed that system, they'll tell you that for two reasons. They'll tell you for quality control and enforcement. Quality control, when you have to monetize tax benefits, you are bringing in large financial institutions that are looking at the deals, underwriting the deals. And from an enforcement standpoint, you're dealing with the IRS, where there's a recapture mechanism if the project isn't being used for its intended purposes. One thing to understand is the difference between a credit and a deduction. A tax credit is a dollar-for-dollar reduction of one's tax liability. A deduction, or depreciation deduction, in the case here, is a 35 cents per dollar reduction of one's tax liability. Two types of credits: production-based credits and investment-based credits. Production-based credit is the production tax credit, which is a credit that's based on the production of electricity over a 10-year period. And excuse me, I've got a pretty bad cold that I'm dealing with. The investment tax credit is a credit that's based on the invested capital committed to the project. Depreciation, we have a system for renewable energy called MAKERS. Basically what it is, in the renewable energy space, it's a 5-year depreciation for the equipment, and then it's accelerated, so you're getting more of it up front in the earlier years. We had something called bonus depreciation that ended last year. We're hoping it gets extended, and that gave you a depreciation deduction in the first year that the project was placed in service of 50%. So in the first year, you were effectively getting more than 50% of the value of the equipment in deductions. There's some limitations on your ability to use both tax credits and depreciation deductions. One, when you're dealing with a membership interest or a partnership interest, you have to have enough tax basis, which means that you have to have between the capital that you put into the deal and the debt that the deal has, the debt's going to get allocated to the different members in an LLC. And in order for you to take all the losses out of out of a piece of property, you have to make sure that the debt is allocated to you as the investor. This becomes an issue with personal guarantees because the party that gives the personal guarantee gets the debt allocated to them. So when you're doing one of these transactions, the investor does not want the developer guaranteeing the debt, personally guaranteeing the debt. There are two other limitations. These come into play quite often. First is called the at-risk rules, and the second is the passive loss rules. At-risk rules basically mean that you can't take credits or depreciation deductions to the extent that you don't have skin in the game. Passive loss rules say that you can't take losses or credits from a transaction and use it against your active participation income. So let me just give you an example. A physician, this is quite common in the 80s. Physician invests in a real estate deal. Physician receives depreciation deductions. Physician takes the depreciation deductions and offsets his or her practicing income tax. What the IRS did to stop that tax shelter is they said, okay, if you are not a material participant in the transaction, then those losses and credits that you get from your passive activities can only be used against your passive income. So this is one of the reasons why your typical individual investor cannot invest in a solar transaction, because the credits that they would receive and the losses that they would receive from that transaction, they can only use against their passive income. And nowadays, it's hard to find people who have passive income. These at-risk rules and passive loss rules do not apply to widely held C corporations. So what is a widely held C corporation? It is someone who's, a C corporation that's not closely held, which means 5 or fewer individuals own more than 50% of the corporation. So this is one of the reasons why Wall Street financial institutions tend to be the investors in these deals. One of the reasons they're not subject to the passive loss and at-risk rules. 2, they have underwriting capabilities. And 3, many of these folks were your usual suspects for tax credit financing for low-income housing tax credits and new markets tax credits. Another trap for the unwary is with respect to related party transactions. This comes into play in the closely held situation where you have a manufacturer that sells the solar equipment into a project and takes back a note instead of upfront cash. This is a trap for the unwary because when you are selling inventory, you cannot avail yourself of the installment sale rules, which pretty much mean installment sale reporting says that you don't have to report income tax until you get the cash. Well, it's not so if you have an inventory transaction. So we have a lot of clients that get tripped up on that, and